Welcome back to the weekly review for calendar week 15, and what a week it was. On Tuesday, Trump announces a ceasefire. On Saturday, negotiations in Islamabad fail. The CPI comes in at plus 3.3%, the highest value since May 2024. And gasoline accounts for 3/4 of this rise. Oil is back to $97 WTI, down from over 110, thanks to the ceasefire. Hope gold at $4,752, VIX down to 19. The fear and greed index climbed from early 23 to over 38, still in fear, but the panic is subsiding a bit. Today we'll look at what happened and what that means for oil, gold, and also shipping and dividends, and what's coming our way next week. Let's start with geopolitics. So the ceasefire failed. What happened? On Tuesday, the UN mediated a ceasefire between the US and Iran. Trump celebrates, the markets join in, S&P green for 4 days straight. Hormuz is to be opened. Iran wants to levy a $1 per barrel toll in crypto. Yes, in crypto. By Thursday, the ceasefire is already shaky. Iran accuses Israel of breaking the ceasefire in Lebanon. Hormuz remains de facto restricted. Currently, 16 ships have passed through, but under Iranian control. Then on Saturday, VP Vance flies to Islamabad for 21 hours of negotiations, and currently no deal. According to Vance, Iran shows no fundamental commitment on the nuclear issue. 21 attacks on merchant ships since the war began. Hormuz has been in crisis for over 42 days now on all this, since the 28th of February 2026. And then on Friday, the CPI report, March inflation plus 3.3% year on year, plus 0.9% month on month. Energy at plus 10.9%, gasoline at plus 21.2%. Hormuz is driving inflation directly into the US economy. The Fed is trapped. It can't cut rates because inflation is rising. FOMC minutes from Wednesday 11 to 1 for a rate pause. 7 out of 19 members see 0 cuts this year. The current assessment, as long as Hormuz remains blocked for Western ships, oil stays above $90, gold above $4,500, and tanker rates here are at extreme levels, and that's the new normal for now. Don't bet on a quick fix here. Now to the macro. WTI at $96, Brent at $95, significantly down from the panic highs of over 110. Thanks to the ceasefire, hope, gold at $4,752, silver at $76. Third week in a row in the green here. S&P 500 at 6,817, that's plus 3.6% for the week. A ceasefire rally, so to speak. DAX 23,804, VIX at 19.2. Significantly down from 24, but fear and greed is staying right at 38, and that's just 4. Up from 23 on Monday. Panic is subsiding, but confidence is still lacking here. Euro US dollar at $1.17. The euro is currently strong and the dollar is weak. The 10-year bonds at 4.34%, slightly up from last week. The yield curve is currently positive. Normal, so no recession signal here. SARM rule 0.2, well below the trigger. That means financial stress is negative here. The labor market, 219,000 initial claims, but consumer sentiment at 56.6. Consumers are simply pessimistic here. Manufacturing index at 98.3. Slowdown mixed signals. Conclusion for now. No crash, no recession, but currently just a transition phase. That means just being selective here. And what I'd like to add briefly is definitely about consumer sentiment. We're seeing that right now with many stocks like Unilever, Mondelez. Look at them all seemingly at 52-week lows. Currently, now to energy and oil, WTI at $97, Brent at $95 now, week 6. To the Hormuz blockade. Interesting, the oil price has come back from the panic highs of over $110. The ceasefire attempt briefly took some pressure off, but the risk premium simply remains as long as Hormuz is closed. Exxon at $155 pullback from the all-time high of $171 since late March. That's about minus 9%. Chevron, on the other hand, gets an upgrade. JP Morgan raises the price target to $216. ConocoPhillips plus 12.6 in the last month. Equinor back to $38.50 after the all-time high of $42.40. Truist has upgraded the entire energy sector to attractive. The thesis, as long as oil stays above $90, the majors earn above average. Buybacks are running, dividends are safe. European oilers like Shell and TotalEnergies benefit from the rerouting of oil flows. What you also have to see here are all the small cap stocks like Panoro Energy, for example, or all the smaller values that simply have a favorable break even here. They are really making a fortune at these prices. That's just how it is. Now, let's move on to gold and commodities. Gold at $4,752 near all-time high here. The combination of dollar weakness, central bank purchases, and geopolitical uncertainty continues to drive it. Silver at $76, third green week in a row here. Among the miners, the situation is currently split. Glencore best performer in the sector, plus 37% year to date. But you also have to say that it was, of course, also a bit rallied by such takeover rumors, or rather takeover attempts that were then rejected. But Newmont with around minus 10% since the January all-time high. Barrick even at minus 32% since February. They have a legal dispute with Newmont over the Energean mine. Newmont accuses Barrick of resource piracy. The top 50 miners still gained $250 billion in market value in 2026, and simply supporting gold here. Copper also benefits. Rio Tinto and BHP are jointly investing $500 million in the Resolution mine in Arizona. Long-term bullish here for copper. The defense cycle plus electrification are driving prices or even demand here. Shipping, tankers, and rates. And now it's getting interesting too. Tanker rates are still at an absolute extreme level. VLCCs at over $400,000 per day. All-time high range Suezmax at around 130,000. Aframax at about 78,000. The blockade is forcing everything onto longer routes. Cape of Good Hope instead of Hormuz, and that's tying up capacity massively here. But the ceasefire attempt on Tuesday showed that a diplomatic solution could simply come at any time, then rates will drop brutally fast. Tanker rates are just a peak cycle, and here you can of course also consider whether you might want to take some profits or not. For me, I'm just staying invested because I say buy and hold and I get a good dividend. If the price falls, I'll just buy more at a lower price, but that's just my strategy. Of course, everyone can see it differently. Ultimately, dry bulk like Star Bulk, for example, is also a long-term infrastructure play. Simply because they also, let's say, ship hard assets around, like grain, for example, or copper or whatever. And that definitely has added value and has to be shipped. Now let's move on to the tariffs, Fed, and dividend news. Briefly on the tariffs here. Trump has announced new steel, aluminum, and copper tariffs. 50% on finished products, 25% on derivatives, plus a 50% threat against countries supplying weapons to Iran. Analysts are currently calling this an empty threat. After the Supreme Court ruling against EPA tariffs, he's now shifting to the Trade Act of 1974, 10% blanket tariff for 150 days. Average burden around $1,500 per US household. The Fed remains on pause, 3.5 to 3.75. Next FOMC on the 28th of April, the ECB also unchanged. Deposit rate at 2%, next meeting on the 29th of April. Both sides are squeezed. Inflation too high to lower, economy too fragile to raise. AKRBP reported negative free cash flow. Free cash flow minus 365% quarter over quarter. The dividend is currently being paid from reserves, dividend cut risk, and Hercules Capital has received a price target reduction. Piper Sandler down to $16.05. Now let's move on to the outlook for calendar week 16. First, Torm is paying a dividend, which means they have their ex-date on the 15th of April. If you still want to collect the dividend, feel free to take a look. Second, US PPI on Tuesday, estimate plus 1.2% compared to the previous month. Shows whether the oil price shock is also reaching the producers. After the CPI shock, on Friday, everyone's watching this. Third, New York Empire State Manufacturing. On Wednesday, estimate 0.5, basically stagnation below zero. That would be a warning sign here. Fourth, EU CPI on Thursday, estimate 2.5% compared to last year. Important for the ECB decision late April here. Fifth, FOMC on the 28th April and ECB on the 29th April. The big rate decisions are coming at month end. The question is, does the CPI shock change expectations? Currently, the market price is in a Fed hold, but if the PPI also comes in hot, even a hike could be discussed again. And that would obviously not be positive for the market. Otherwise, I'd say I've already given you a very good overview, I'd say, of everything that happened this past week. One quick thing to add, if you can't watch all the videos for the weekly review, I also offer a newsletter on my site, mbcapitalstrategies.com. You can sign up for the newsletter there and get the weekly review nicely summarized. From me, maybe even a bit more informative, like a bit more of a deep dive, just for your info if you don't have time to always, watch 10-minute videos, but I do try to keep them as short as possible. So if you like the video, I'd appreciate a like right here. If you're not a subscriber yet and don't want to miss anything else, I'd love for you to subscribe. I regularly provide portfolio updates, then other series. Currently, the Upstream series is running. I had a full mining series. These are all stocks I hold in my own portfolio, which is why I report on them. They're ultimately just quarterly reports I publish, analyze, and then present to you. Okay, that was a short one. Well, a long short one, but otherwise that's basically it. Much of this is not investment advice, obviously. And currently all the tanker rates have also massively pulled upwards. You can see it in the prices too. They ultimately just followed suit. Well, I'm curious. To hear your assessment, feel free to leave a comment on how you see the current situation and what I should maybe focus on more in the future. Just write to me and let me know. Otherwise, as always,